Hey everyone! Since the onset of the pandemic back in 2020, the economy has gone through several cycles. Most types of commercial real estate ebbed and flowed with the broader economy. In the relatively tight cycles, different property types saw space demand rise and fall very quickly. But elevated inflation, tighter financial markets, and risks of a recession have begun to take a toll. In this video, I'll highlight markets where each property type has a lower vacancy rate in the first quarter of this year than it did in the first quarter of 2020, prior to the pandemic. And I'll start with the property type hit hardest this cycle, office. As everyone's well aware at this point, the office market is still grappling with the residuals of the pandemic. New behavior patterns, including working from home and the hybrid work week, together with people relocating to the suburbs or to entirely different cities from where their job is located, have dramatically reduced the need for office space. The overall vacancy rate for office in the first quarter of 2023 nationally was 16.8%, up from 12.7% in the first quarter of 2020. But not all markets have been affected in the same way. The office vacancy rate in Miami, Florida stands at 11.8%, the exact same level it was in the first quarter of 2020. Another market that has done well is Las Vegas, where the most current office vacancy rate is 12.4%, down 40 basis points from before the pandemic. The market generating the best comparative results is West Palm Beach, where office vacancy now stands at 11.8%, down from 13% 3 years ago. There are some very unique dynamics in each of these metros, but my point is that even the hardest hit property type still has some pockets of well-performing assets. Now I'll focus on multi-tenant retail. As we went into the pandemic, many people believed that a new death warrant had been signed on the retail sector. But retail properties demonstrated tremendous resilience throughout the health crisis. Today, despite highly publicized store closings like Bed Bath & Beyond, retail is outperforming. The national vacancy rate for multi-tenant retail is 5.6%, down 10 basis points from where the sector was in the first quarter of 2020. There are 24 different major markets across the country where the retail vacancy rate today is below where it was in the first quarter of 2020. The apartment market has had its up and downs over the last 3 years. In the first quarter of 2022, the apartment vacancy rate hit a record low 2.5%. It has since rebounded, climbing to a national average of 5.2%. That rise has been driven by a combination of elevated construction and slower household formation. That said, there are 3 markets across the country where the current apartment vacancy rate is the same as it was in the first quarter of 2020. That includes Miami, Milwaukee, Wisconsin, and Orange County, California. 4 other markets are performing better today than they were in 2020, including San Diego, Chicago, New York, and northern New Jersey. Industrial properties also traversed a cycle, reaching a record low national vacancy rate of 3.6% in the second and third quarters of last year. Since then, the vacancy rate has risen to 4%, but absorption has been positive for 52 consecutive quarters. The rise in vacancy over the last 6 months has largely been driven by a wave of construction. The average industrial rate in the first quarter of this year was better than it was in the first quarter of 2020 in 40 of the 48 major markets we track. Self-storage has also performed well, with the national average vacancy rate down 80 basis points from 10.1% to 9.3%, and with 23 markets outperforming their pre-pandemic vacancy levels. Self-storage has historically outperformed most other property types during economic down cycles, which makes this property type particularly attractive to investors when the broader economy faces increased risk. On the flip side, hospitality properties tend to be more vulnerable to down cycles, but hotel demand has made a strong recovery from the health crisis. The overall trailing 12-month hotel occupancy rate as of February 2023 was 63.3%, a bit lower than in February 2020 when it was 65.8%. But I do want to point out that the average daily rate is almost 15% higher than it was in 2020. So while there has absolutely been some softening in many of the commercial real estate property types and markets, not everything is being affected the same way. That's why, despite the many headwinds the sector faces, there are many investment opportunities available for investors who are willing to dig a little deeper and who keep their eyes on the horizon.